you are probably making investing harder than it needs to be, and it is costing you real money. According to the most recent S&P Dow Jones Indices SPIVA scorecard, over the 15-year period ending December 2024, there was not a single category of actively managed domestic equity funds in which the majority of managers outperformed their benchmark index. Not one category. And over the full 20-year period from 2005 through 2024, 94.1% of all domestic active funds underperformed the S&P 1500 Composite Index. The people failing to beat the market are not amateurs guessing on social media. They are credentialed professionals at major financial institutions with dedicated teams of analysts, decades of training, access to company management, proprietary data feeds, and research budgets that dwarf anything available to an individual investor. And still, over long time horizons, roughly 9 in 10 of them fall short of simply owning the market. So when you are sitting at your laptop refreshing stock prices, analyzing earnings reports, and trying to time your next move, you are engaging in a game where 9 out of 10 of the most prepared, best-resourced professionals in the world have historically lost, with far fewer tools than they have. That is not a reason to feel discouraged about your own abilities. It is a reason to reconsider the game itself. Because if the most qualified, best-resourced participants in the game consistently fall short of simply owning the market, perhaps the smartest strategy is not to compete with them at all. That is the core idea behind what I call the one-decision portfolio. And once you understand it clearly, your entire relationship with investing may become both significantly simpler and meaningfully more effective than anything you have tried before. Let's start with the psychology, because the psychology is where this all begins, where most investors undermine themselves, and where no amount of financial information alone will fix things without it. Brad Barber and Terence O'Dean, economists at the University of California, published some of the most cited research in behavioral finance on this question. After analyzing the trading records of nearly 65,000 individual investor households across multiple years, they found a consistent and clear pattern. The investors who traded most frequently earned the lowest returns, not because they were choosing bad companies, but because trading itself is expensive. Every transaction carries direct costs. Every buy and sell in a taxable account creates a potential tax consequence. And every additional decision introduces another opportunity for the most destructive behavioral pattern in personal investing to take hold: overconfidence. Overconfidence in investing is more subtle than it sounds. It is not arrogance. It is the natural human tendency to believe that your interpretation of available information, your read on a sector, your instinct about a quarterly result, your timing on a particular position, is more accurate than it actually is. Barber and O'Dean found that overconfident investors trade excessively, and that excessive trading consistently reduces net returns over time, even before accounting for tax drag. The more active the investor, on average, the worse the result. This finding has been replicated across different time periods, different countries, and different investor profiles. It is one of the most durable results in all of behavioral finance. What makes this especially important is not just what it means for individual investors. It is what it reveals about the professional fund management industry as a whole. The SPIVA Persistence Scorecard, published at the end of 2024, tracked what happened to the top-performing actively managed domestic equity funds over time. Among all funds in the top quartile of performance as of December 2020, the genuinely best-performing managers in their category at that moment, not a single one remained in the top quartile over the following 4 years. Not one. Past top quartile performance provided no statistically meaningful prediction of future top quartile performance. Finding a manager with a strong recent track record tells you almost nothing reliable about whether they will outperform going forward. This is what Morgan Housel, author of The Psychology of Money, is pointing at when he argues that building wealth through investing is less about analytical skill and more about temperament. He describes the willingness to sit still when instinct is urging action as one of the most financially consequential habits a person can develop. The ability to hold through a sharp market correction when every news headline is frightening. The discipline to keep investing automatically every month without letting short-term movement alter a long-term plan. Those behaviors cost nothing to implement, They require no credentials or research ability, but they are psychologically far more difficult than selecting stocks, which is precisely why most people never sustain them. Now let's talk about what the one-decision portfolio actually is, because the specifics matter and are easy to miss in a concept that sounds deceptively vague. You make one deliberate decision. You are going to automatically invest a fixed amount every single month into a low-cost index fund tracking either the total U.S. stock market or the Standard & Poor's 500 index. You choose a fund with the lowest available expense ratio. The best options in this category charge between 0.03 and 0.05% annually, which is essentially the cost of nothing compared to the 1 to 2% charged annually by most actively managed funds. You set up automatic contributions, so the process requires no ongoing willpower or weekly decisions. And then you do not check it every day. You do not shift allocations when markets fall. You do not move to cash based on a macro prediction. You made one decision. You now let time and compounding work without interruption. This is not a new idea. Jack Bogle launched the first publicly available index fund through Vanguard in 1976. The financial industry at the time mocked it loudly, calling it an approach that accepted mediocrity. Bogle's argument was straightforward. Owning the entire market at near zero cost, year after year, without interference or market timing, would outperform most active strategies across every meaningful time horizon. He called it winning by not losing, and the simplicity of that framing disguised how genuinely difficult it would prove to execute for most investors. Nearly 50 years of data have since validated that position through recessions, sharp recoveries, technology booms, financial crises, and every other market environment that has appeared along the way. The index keeps owning everything, charging almost nothing, and outperforming the overwhelming majority of professionals who are paid to do better. And then there is the bet that made the point impossible to argue with. In 2007, Warren Buffett publicly challenged the hedge fund industry to prove their value. He bet that a simple S&P 500 index fund would outperform any portfolio of at least 5 hedge funds over 10 years, net of all fees. Ted Seides of Protégé Partners accepted. At the end of 2017, the result was not close. The Vanguard S&P 500 index fund Buffett chose returned 125.8%. The 5 fund of funds Seides selected returned between 2.8 and 87.7%, every single one falling short of the index by a gap that would have translated into tens of thousands of dollars of difference on any meaningful investment. And Buffett's own written instructions for managing his wife's inheritance, published in his 2013 letter to Berkshire Hathaway shareholders, were simply this: 90% in a low-cost S&P 500 index fund, 10% in short-term government bonds. The most widely respected investor in American history did not recommend hiring a skilled active manager. He said, "Own the market cheaply and leave it alone." Here is why fees matter more than most people intuitively grasp, because the damage only becomes visible in the compounding. The average actively managed large-cap fund in the United States charges approximately 1% per year. A comparable index fund tracking the same market charges roughly 0.04%. That gap looks small, less than 1%. But on a $100,000 portfolio earning 10% annually over 30 years, that fee differential costs you approximately $200,000 in final account value. You are not paying for one service. You are forfeiting an entire decade of compound growth. And the fund manager does not need to underperform to cause that loss. They only need to perform in line with the market they are being paid to beat. Here is a useful way to feel it. If the market earns 10%, and your actively managed fund also earns 10% before fees, a better outcome than most active managers actually deliver, the fund investor walks away with approximately 9%, while the index investor keeps 9.96. Compounded across 20 or 30 years, that small annual gap becomes the kind of difference that changes retirement timelines by years. Now, some people will push back and ask about the managers who genuinely do beat the market consistently. They exist. The problem is identifying them in advance, before that outperformance is reflected in their reputation, fund size, or fee structure. The SPIVA persistence data is the most rigorous available evidence on this question, and it says clearly, Past top quartile performance does not reliably predict future top quartile performance. Picking a manager based on a strong track record is making a fee-guaranteed payment in exchange for a performance outcome that the data says is largely unpredictable across the time horizons that matter most. The genuine psychological difficulty here is not in following the logic. Most people, when they encounter this evidence directly, find it compelling. The barrier is that doing less actively feels wrong. It feels like neglecting your financial future. Daniel Kahneman's research on how humans make decisions under uncertainty helps explain why. People are wired to believe that effort produces better outcomes, that complexity signals diligence, and that monitoring and adjusting demonstrates financial responsibility. Holding a simple index position while markets fluctuate and news cycles churn feels uncomfortable, even when the evidence overwhelmingly supports it. The impulse to act is not irrational. It is deeply human. But in long-term investing, it is one of the most expensive impulses you can regularly indulge. Here is where this all becomes actionable, your concrete step for this week. If you do not already have a dedicated tax-advantaged investment account, open one now. A Roth IRA if your income qualifies, or a traditional IRA at a low-cost brokerage. Fidelity, Vanguard, and Schwab all offer total market and S&P 500 index funds with expense ratios below 0.1%. Choose one fund, just one, and set up an automatic monthly contribution of whatever amount your budget currently allows. Even a modest starting amount builds the structure and the habit. Then schedule one annual check-in, not to react or adjust your allocation, but simply to confirm the plan is on track and to increase your contribution if your income has grown since the last review. That is the entire system. One account, one fund, one automatic monthly transfer. One calendar reminder each year to confirm the plan is on track and adjust contributions upward if income has grown. Nothing else is required. The One Decision portfolio does not require an understanding of monetary policy, earnings cycles, or sector rotation. It requires one decision, clear, deliberate, and grounded in decades of evidence, and then the sustained discipline to not undo it every time the market creates pressure to act. The single most important insight from this video is not about index funds specifically. It is about the relationship between action and outcomes in long-term investing. More decisions do not produce better results. More monitoring does not produce better returns. More complexity does not protect your wealth. The SPIVA data spanning 2 decades, the research of Barber and O'Dean on investor behavior, and the clear result of Buffett's 10-year bet all point to the same place, that the capacity to act deliberately once, automate consistently, and then resist the impulse to intervene is one of the most financially valuable and most underrated skills in personal investing. The investors who build lasting, meaningful wealth quietly over time are not the ones with the most sophisticated systems or the most carefully researched portfolios. They are the ones who made a clear and informed decision early, automated the execution so it required no ongoing willpower, and then made the disciplined and underrated choice to get out of their own way. That behavioral understanding, knowing precisely why our instincts tend to work against us with money, and having a clear alternative framework to apply, is the foundation of everything we build here at NextGen Finance. If that kind of research-backed financial thinking is useful to you, subscribing means you will never miss a video designed to give you a concrete, lasting edge in your personal financial life. Each week, we bring you the behavioral science, current research, and practical frameworks that most mainstream investing content either skips entirely or buries under unnecessary complexity. Drop a comment below and tell me, are you currently using a passive index approach with automatic contributions, or do you still feel the pull to manage your investments more actively? And if you do still feel that pull, what is driving it? I want to know where you honestly are on this. I read every single comment. This video is for educational purposes only and is not financial or investment advice. Please do your own research and consult a licensed financial professional before making any financial decisions.